What if I told you that two investors can buy very similar mortgage notes in similar neighborhoods at similar prices, and 6 months later, one feels confident and calm, while the other one is completely stressed out and second guessing everything? The difference usually isn't the asset, it's their risk profile. If you're learning about mortgage note investing, understanding your risk profile is one of the most important foundations that you can build. Before you analyze deals, before you look at returns, before you structure an exit strategy, you need to understand yourself as an investor. So let's talk about what a risk profile is, why it matters, and how you can identify yours. At its core, a risk profile describes your overall relationship with risk when it comes to investing. It combines two very important elements: your risk tolerance and your risk capacity. Risk tolerance is emotional. It's about how comfortable you are with uncertainty. How do you react when something doesn't go according to plan? Can you stay calm when there are delays? Or do you feel anxious when outcomes are unpredictable? Risk capacity, on the other hand, is financial. It offers the question: how much risk can you actually afford to take? If a deal takes longer than expected, do you have the reserves? If income pauses temporarily, does it impact your lifestyle? A lot of investors only think about tolerance. They say things like, I'm aggressive or I'm conservative. But in mortgage note investing, and any investing for that matter, both tolerance and capacity matters equally. And here's why. Mortgage note investing is not just simply a push-button asset class. When you buy a note, you are buying a loan secured by real estate. You are stepping into the shoes of an existing financial agreement between a borrower and a lender. That means outcomes can depend on borrower behavior, legal timelines, servicing processes, and market conditions. Some notes perform exactly as expected. Borrowers make payments. Cash flow comes in monthly. Everything runs smoothly. Other notes requires patience. A borrower might fall behind. A workout plan might need to be negotiated. Legal processes like foreclosures can take months when it's needed, and sometimes longer than expected. None of that is unusual in this space. It's just simple part of the business. Now, how do you handle those situations? Emotionally and financially depends on your risk profile. Generally, investors fall into one of three broad categories: conservative, moderate, and aggressive. These aren't labels meant to limit you. They're simply frameworks to help you understand where you're most comfortable. A conservative investor prioritizes stability and capital preservation. They care deeply about protecting principal. They prefer predictability. They value peace of mind over chasing the highest possible return. In mortgage note investing, a conservative investor might focus on, for example, performing first lien notes. These are loans where the borrower is already making payments consistently every month. They may look for strong equity positions, lower loan-to-value ratios, and properties in stable markets. The returns might not be the highest in the space, but the trade-off is greater predictability. If you're someone who prefers steady income and wants to minimize surprises, you may lean towards a conservative risk profile. A moderate investor balances stability and opportunity. They're comfortable with some level of uncertainty as long as it's calculated and structured. In the note world, this might mean investing in reperforming loans. Borrowers who were previously delinquent but are now back on track. Or perhaps likely non-performing notes where there's a clear workout potential. Moderate investors understand there may be bumps in the road. They plan for delays. They build reserves. They accept that timelines are not always perfect. but they're willing to take on that additional complexity in exchange for a stronger potential return. Many mortgage note investors fall into this category because it allows them to balance income with opportunity. Then there's the aggressive investors. Aggressive doesn't mean reckless. It simply means comfortable with complexity, longer timelines, and higher uncertainty. Aggressive note investors may pursue deeply non-performing loans, foreclosure strategies, vacant properties, or junior liens purchased at often a significant discount. These strategies can offer higher potential returns, but they require patience, experience, and strong capital reserves. Legal timelines can stretch, unexpected costs can arise, markets can shift. An aggressive investor expects those realities and prepares for them in advance. Now here's where it gets really important. Your risk tolerance and your risk capacity must align. You might emotionally feel comfortable with aggressive strategies. You might enjoy the challenge. But if the capital you're investing is money you cannot afford to tie up, like retirement funds or depend on an emergency saving, then your risk capacity may not support the aggressive deals. On the other hand, you might have strong financial reserves but realize that uncertainty causes you significant stress. In that case, even if you can afford more complex deals, they may not be the right for you at this stage. Mortgage note investing rewards patience and preparation. It's not about eliminating risk. It's about understanding it and managing it intentionally. If you don't align your investment with your risk profile, several things might happen. You might panic during normal delays. You might exit deals way too early. Or you might hesitate at critical decision points. Or maybe you avoid good opportunities because they feel uncomfortable. But when your strategy matches your risk profile, something powerful happens. You feel steady. You make decisions from logic instead of emotion. You understand that temporary challenges are part of the process, and you're able to stay focused on long-term results. So how do you identify your profile? Simply start by asking yourself some honest questions. If a borrower stopped paying tomorrow, how would you feel? Do you have the financial reserves to carry a note through a long legal timeline if necessary? Am I investing for steady monthly income, long-term asset growth, or a combination of both? How diversified am I outside of mortgage notes? Is this capital essential to my lifestyle, or is it truly investment capital? Be honest, not optimistic, not aspirational, but be honest with yourself. Your risk profile today may not be the same as your profile in 5 years from now. As you gain experience, build reserves, and deepen your understanding of the note space, your comfort level also may evolve. And that's normal. What matters most is alignment at every stage of your investing journey. Mortgage note investing is a powerful asset class. It allows investors to create income streams, acquire discounted assets, and participate in real estate without directly managing properties. But success in this space doesn't come from chasing the highest return. It comes from building a strategy that matches your financial reality and your personal temperament. When you understand your risk profile, you protect more than just your capital. You protect your confidence, your clarity, and you protect your ability to make sound decisions over the long term. Hey, if you found this helpful, please follow us for more educational videos in this mortgage note investing series, where we continue breaking down concepts, strategies, and real-world scenarios step by step. And if you'd like to explore more educational resources on mortgage note investing, please visit us at ritzelnotes.com. and we hope to see you in the next lesson.